All right, guys, I guess we're going to start trying to keep this on time so we can actually get to drinks. Let me do a quick intro. I'm a one-man panel, so I don't get this is all you get, whatever comes up here and me. I'm a co-founder and CIO of a firm called Blue Elephant Capital Management. We are an investor in peer-to-peer space. We have a 2-year track record. Before that, I ran about $300 billion of fixed income at BlackRock, where I ran institutional fixed income on the fundamental side. Pension funds, endowments, all the sought-after investors that have been mentioned in this room were my old clients. And I left that job about a year ago, trying to see what was out there in the world. I mean, fixed income, for anyone who follows it, has kind of become low yielding, boring, correlated to other assets. And having seen that and having to deal with a lot of it and its illiquidity, I decided to go find something that was higher yielding and less liquid, and peer-to-peer ended up being that asset class. But I think, listen, no asset manager, money manager, no one on CNBC, no one has the answer to give you. So I'm not going to stand here and I'm not going to tell you which platforms we like, what we don't like. There's no answer here. I have some opinions. I think they're founded on facts and experience. So I'm going to go through a few things that I think about when I think about the space and how to put a portfolio together. And listen, everyone's goal is the same, right? Is to maximize your yield and never lose money. And the plight of the fixed income investor is that, listen, a venture capitalist invests small amounts of money in lots of things. Some of those might return 100x. I've been doing fixed income a long time. I've never gotten 100x. I don't know what it feels like. You invest something, you look for a couple points a year. Maybe you can get 12, maybe you can get more, but when you don't get that, you get 0. And it's the 0 that kills you, right? And so the goal of everyone in this room is to raise capital or invest capital in a venture that maximizes their return without minimizing your risk. And again, I'm going to talk about it from the fixed income standpoint. So I'm not generally an equity investor in these products. I'm trying to look at avoiding potholes, and that is a big part of fixed income. So, I mean, you've heard a lot of opinions up here already, where to invest, Europe, the UK, the continent, the US. I like to start actually even a bit more simpler than that. A lot of people can hide behind terms, right? Big data or, speed to market. Those are great. But what pays the bills in any loan is the finance. Right? How much is the borrower going to pay me back and when? And how do I know that? So the number one thing when we start to think about how to build our portfolio is evaluating platforms. And I have a big slide on this in a minute to talk about how you might think about all these different opportunities that are in front of you as an investor. There's another part to it, though. It's just as big. It probably should be parallel to it. It's your macro outlook. And I said no one has the answer as an investor, but you got to have a view. Right? You can't just buy the highest yielding thing or the safest thing unless there's a reason behind that helps you form that view. And that's what I spent my career doing. When you allocate money to fixed income, it's never as liquid as you want it to be when you're wrong, right? So the idea is what to avoid and when. So for example, if you haven't had high yield in your portfolio this year, you've done a lot better than if you have. And obviously that's subject to name specifics. But you have to have a view on the space. You can't just be out there piling money into different things and hoping it's going to work out. That's really not a great answer. And another thing is you can hedge. Right? We can talk about these markets as being different, higher yielding. They're correlated. What do I mean? If the unemployment rate in whatever country you're investing in goes up and you're making consumer loans, your performance will go down. Right? So your question is, where are you in a business cycle? What other asset classes are correlated? And how do you approach those? And also I'd say we don't live in a vacuum, right? So we talked about what happens if interest rates go up, credit cycles change. If high yield markets go up 500 basis points more, capital that's been flying into this space will go back to the high yield market. Simple, right? And that's going to affect how you should invest in this space. And then beyond that, there's really 2 other avenues you have to look at. The first is the micro, the credit analysis, right? You can get into the credit model. But by the way, if the broad lending stinks or the thesis stinks, the credit model doesn't matter. You're not going to save yourself from the macro side with the micro. Now, if you're a bottoms-up lender, then you better be able to explain to us what the model is. And even if you can't show us the secret sauce, you can't hide behind the terms, right? If you can't explain to me your model in a couple sentences and give me a couple variables that are important to it, there just won't be a conversation. We're not investing in black boxes. And I mentioned FICO in here. It doesn't have to be FICO. You have to be able to score loans, show quality, differentiation, what gets rejected or what doesn't get rejected. And the other side of the equation is, can I leverage it? And we talked about that, right? The question really is, do I want to buy the worst asset out there at the highest yield, or can I build a portfolio of safe assets, leverage it, and get the same return or better with better risk? So those are just some broad things that I think about from the investment process side. So in our fund, and I'm not going to go through who we've approved and who we haven't, I would say that we've looked at over 75 platforms, and we've approved 5. right? So when you start to ask these questions, you start to get different answers than you might if you're a VC firm. Again, I get why an equity firm might put a lot of money into very many platforms. It's different for me. If I talk to a lender who's venture capital funded, and I give them if I give them a $50 million commitment, I'm going to increase their equity value by a huge percentage while I've done nothing for my investors. So you have to figure out how to align those interests. To date, we've invested about $107 million of loans across those 5 platforms. We've done a securitization, just like the BlackRock one. It was 144A. Citibank led it. So we've used banks. We've used all the different things that we've talked about in this room to make loans. But really, based on this criteria, is kind of how we got the loans into the portfolio. And this is the slide that I talked about. It may be hard to read. I'll walk you through a couple of the things. Number one question when we're investing in a platform: what problem does the platform solve? You'll be amazed how many times the platform will fail that, right? You can have the best model in the world, the best speed to market. You have to be solving a problem, right? If I want, the best examples, of course, are the Prosperous lending clubs in the U.S., where the problem was credit card rates really hadn't come down in a very long time, and the data existed to make those same loans at lower rates and pass those rates on to investors and the savings on to consumers. The second question is, are you screening for moral hazard? And this is another big problem, right? We avoid platforms where you're getting, and I hate to say it this way, the rejects, right? The truth is, in many of the countries we're talking about, the capital markets are very well established. So what you want to avoid when you're talking to some lenders is, am I getting the guys who everyone else said no to? So again, big data is great if it solves the problem, and if you can show me that you're not getting the guys who effectively I don't want. And that's really the top of our macro card. And again, same idea. How are the borrowers sourced? What channels do they come through? I mean, this conversation can go on for a long time. There are some channels that we've seen that are very, very good, and some that are poor. I'll give you an example. We were the first funder of a non-US dollar platform, and we always think that being early on, the lending box will be the tightest, right? When you make your first set of loans, if you screw those up, you probably don't get a second chance. So we started the book, and the book's been great. There were about a dozen loans that were made before the company started advertising. The borrowers found them online before they started marketing. Those are the worst loans that we've funded. In other words, there was moral hazard. Those borrowers were midnight on a Saturday night were saying, how am I going to pay off my debt? Someone help me. And they found a website that basically didn't exist, and those loans didn't perform well. So sourcing your borrowers is very, very important. And again, this is where we all kind of get stuck in focus, is the credit model. Notice it's kind of third on my list. With a lot of platforms, I don't even get to this point before I've said, sorry, we don't have anything to talk about. But the credit model is really interesting, because you'll find people who claim that they have black boxes, they can't tell you anything. It's all based on big data, and it's very proprietary. And again, we don't have any of those partners, because if I can't use my macro view. Where do you fit into my portfolio? Are you giving me geographic diversity, credit diversity? There's got to be some reason why I want to have you in the book. So again, I'm not trying to compete with you. I'm not a lender. I don't want to recreate your loan book and go do it myself. But I need to know some very simple things. If you look at the more successful platforms that are out there, a lot of them have taken a very simple model, which they've effectively released to the public, and they made it more and more and more interesting. Another thing, defaults. I have to have some way of understanding your defaults. I don't like hearing we've never had a default, because now I have no idea what to think about your book, unless you're going to tell me you're never going to have a default, which I'm a little skeptical about. Right? In fixed income, there's defaults. As I said, your zero is what kills you. What causes zero? It's fine. It's going to happen. In a book of 10,000 consumer loans, you're going to have a large number of defaults. It's okay. What do you learn from those defaults? What if I stress test a couple of these key variables? What would your defaults do then? If we can't have that conversation, we can't invest, again, because I don't know what I'm investing in. The yield and the expected return is not enough. I'm sure we don't never spend enough time talking about this. Operational. Making a loan is actually easy. I can make any one of you a loan right now, and then you're going to walk out the door. How do I service the loan? How do I track you down? What if you don't pay me? What are my first steps? What are my third steps? At what point do I say, forget it, I'm going to give it to collections? At what point do I file a lien if it's secured? These are all things that, if there's 3 guys in a room and they have the best model in the world, the technology doesn't pay the bills, the finance does. They have to have answers to those questions. And by the way, reporting is one of the hardest parts about the whole space. We have very serious technology platforms that are great partners that can't get us a monthly report within 5 business days at the end of the month. Right? I mean, operationally, not a lot of time has been spent on the reporting side of the business, and a lot of times the servicing side too. So you got to be careful there. And again, you got to keep going through these things because you're going to find slippage, right? So a couple partners that we have, we've changed the definition of what we'll invest in because we've noticed that the yields have gone down and the quality has gone down too. They didn't tell us that; it wasn't volunteered. But we said, you know what? That's over. We can't have that. So you can't take these things on faith. These, especially platforms that are going to be forced to do volume by equity backers. You really need to take a good hard look at what you're doing. And then the big question really is, why do I exist, right? Why don't you guys all go and open an account at all the different platforms you like, go invest it, go about your merry way? And there's a number of reasons. One is there's a number of things we're doing where retail investors will just not be, there won't be access. And the second thing is, again, I think from my experiences in my old life, you can really build a portfolio in this space that does survive different business cycles if, again, you have that view. And I'm going to go through that a little bit. Let me just give you an example. Actually, no, I'm going to do this backwards. I'm going to do my macro scorecard first. This is something you'll see in one of our deep dive decks when an investor comes to us. Really, this is my view in a nutshell, right? Here's a couple things I care about. They're on a piece of paper. So when I'm wrong on these things, and anytime you can call me up and tell me how wrong I was. But the point is this evolves. As data comes out, this will change. What do I think the unemployment rate is going to be? What do I think the Fed funds rate is going to be? Competing asset classes on the bottom. Without this matrix, I have absolutely no anchor for investing in different platforms. And what I'll do is I'll take that platform and I'll build this matrix. Now, I took out platform names on here for some obvious reasons. But effectively, what I've done here is taken what the lender tells us that their base case loss-adjusted yield is. We've taken some models of our own to stress those at kind of half X, 2X, and 3X. These are actually not models. These are just straight line multiples of the loss. And then at the bottom, I've used my macro scorecard to say where I think we're going to be in the business cycle. And what you can see is I've given probabilities to the different lenders having better performance, which is where we've been, or worse performance on kind of a forward basis, since you can't sell the assets that are underlying. And on the right-hand side on the top, that's that's effectively is going to be how I'm going to look at a platform. So obviously, lender E is pretty interesting. Unlevered return of 10.55, whereas lender G, which started out looking pretty good, looks like in a normal environment over a cycle, I think it's going to return 90 basis points. Right? That's a pretty big difference. And I didn't put leverage on here. We go deeper than this. But the bottom line is, to invest in the asset class, you have to have a view on where we are in the macro cycle and what impact that will have on the portfolios, because every single platform, I won't say that they're lying to you about the numbers, but they're, first of all, biased to tell you the numbers are lower because they're the underwriter. They want you to invest. But also, a lot of this stuff is unproven. So the real question is, in a stress scenario, do you really think that loss rates are going to hold in the bands, or do you think there's a reason to believe they may go outside the bands? And so that's why it's a pretty important part of what we do. And just to give you an example of how you might close, why to use a manager like us, like Blue Elephant, we have to generate alpha, right? Again, why don't you just go and open up accounts on all the platforms? Whatever I provide in terms of access also has to come with some sort of alpha. So listen, you just saw my view. If you break it down, I think we're mid to late cycle, which nobody thought 3 months ago, starting to get some more traction now. So we are up in quality, where we're starting to bring our leverage down. You'll notice we own no Prosper loans under the rating of C, where we think the data is more sketchy. We really try to avoid people who think they can outrun the default cycle. Because if you look at a high yield market, the riskiest bond is the 6-month to 1-year bond. Because when that thing goes bad, there's absolutely no chance you're getting your money back. Whereas if you have a term loan, the company may survive. So we're avoiding a lot of the kind of, quote, higher yielding asset classes that are less proven, because we think the downside risk in those will be much, much higher. And that's really how we think about generating alpha. But again, if I think about what we've heard in this room and doing it yourselves, if you don't want to do it through someone like us, the idea really is, don't just look at don't say, oh, that platform said 18 and that one said 12, so I'll take whichever one I feel better about. It's why did they say it? What did they base that on? And don't be afraid to ask those questions of again, where did you get that? And if the answer is I can't tell you, it's based on big data, then be very afraid. And if the answer is, well, we've never had a default, then what happens if you do is a good next question. And again, I think the space is, any question about what inning we're in, I do think it's early, but I think the problem is it's not in a vacuum. So we're early innings in this game, late in the credit cycle, much later better than people think. So you got to be extra careful at this point. Not a great time to be going way down in quality when the world has already had the big rally. And you got to just make sure that you remember there's competing asset classes too. So this is not an asset class. Again, I think it will be a great asset class for investors over time, but you have to use it in the scope that there are other asset classes out there, and you don't always have to be chasing everything. There's good times and bad times to be invested in the space. Wow, that's all the time they gave me. I'm happy to pause and take questions from anyone who has. There's a couple. I'm not sure if there's some. Go ahead, I'll repeat the question.
I haven't asked yet. I thought you
No, there's no. Oh, here comes a mic.
How you
Here.
got to your weightings? Because you said,
Yeah.
Is it because you're a big investor, you can say, I want it on this format, please give me this kind of matrix?
Right. So the question is on the matrix. No, I built this matrix, right? So the only place this matrix is influenced by what I can do on the platform is in the base loss case. So yes, there are some lenders on the left-hand side where people in the retail may not have the same access that I have. In some cases, these are replicable by retail. But that's all the numbers on this page, except for that base case loss-adjusted yield, are my numbers.
But if you were a smaller investor, how would you go about that then?
So again, I would push the platform really hard to say, in your base case, so if I invest in your platform, whatever the index is, first define that for me. I'm going to get 7%. Great. What unemployment, give me the couple variables that make you think that's right. And over the course of a cycle, they'll tell you, right? Which means if we've had 1% defaults for the last 2 years, and you said the average will be 4, that the average in the next couple of years might be 7, 8, something much higher. So it's how do you get there? What do you make of the most recent? And then again, you have to mess with the numbers yourself. The better the data I'm shown and the more I can correlate it to something, the nicer I'm going to be in the probability case. So you can see lender A, I gave a 5% chance of three times the base case loss. And in lender F and G, I gave 25, which tells me that I wasn't impressed by the data model at all. So it's subjective. And by the way, if you're uber bullish, right, if you think rates are going up because the credit cycle is about to get much better, then you'd probably reverse these numbers. I think rates might go up as the credit cycle deteriorates, so I want to push my probabilities out to the riskier side. So it becomes very personal at that point.
I have 2 questions. One is that everything seems to be marked to model. How would I go about getting a mark to market valuation? And the second question I have is once you've bought a pool of loans, you need to liquidate the bad ones. Yep. What is the secondary market?
Great question. So we mark every loan in our book to model, I will say. So we don't carry our loans at par. We think that's a bad idea. The truth is most loans are around par because the rates haven't changed that much. They're bonds. They're actually bonds with no options in them, so they're really easy to model. So if you made a loan at 15% and the platform turns around and says, well, the new rate is 12, well, you've just rallied 300 basis points, so that loan is appreciated. If the rate becomes 18, it's depreciated. Where it matters is if the loan hasn't paid off. Another reason we need to see models. So if a loan doesn't make a payment, what are the chances it ever makes a payment again? That's how you mark a loan down, right? So we have some books, consumer books mostly, where if you miss 2 payments, we actually mark the loan to 50 cents on the dollar because it's based on the math, the stats, about 50% probability that you ever see another payment from those loans again. If we can't answer that question of how we mark the book, probably can't invest in you. So mark to, people do loan loss reserve where they just say, well, they're all par unless we breach some level of, we don't like that model. We think there's actually enough data in the right platforms that you can mark your loan book. Generally, we don't liquidate the loans that failed. We've marked them at 0, and we get whatever we get from recovery rate. So that every month when we print our monthly return, and I can't really advertise the fund and show you a return sheet, but our return actually includes the fact that every loan that's gone past 120 days is marked at 0. So those coming into our fund actually get a full clean mark. If you look at, someone tells you that they've been on a platform personally and they've never had a loss, they just haven't marked it down, right? If you have a loan that's 2 years old and made 3 payments and it's going to mature in a year, it's 0. You don't have to mark it there, but that's where it is. Great, guys. So I know it was a lot in a little bit of time, but I'm easy to find. If people have questions, email. I'll be around. Thanks so much for listening.